This episode is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. Unlock your Edge with 20% off for a limited time. Use special promo code at checkout. For more information about Edge, visit www.laductrading.com/edge.
Hey, greetings, and thank you so much for joining us. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by our macro advisor, Edge manager, Craig Shapiro, who has been in the RV and on the roads across multiple states this summer. So welcome back to your home base in Florida, and hope it's good to be back. But then you're leaving again tomorrow to take your daughter to college. So really glad that we could kind of get together, talk about the economic data, CPI included, that was released this morning, prepare for Jackson Hole next week, and FOMC in September. So this is coming to you publicly, which we make available on occasion, share our analysis, macro to micro. We do this for clients every day, and not just a live trading room that I run, but also the advisory service, which Craig runs, along with our bench of 10 contributors. So we have a phenomenal bench from macro to micro. And this is actually an open Q&A. So if you have questions you want to ask either of us, definitely hit us up in Zoom Q&A. That would be, we'll kind of go through a review of interpretation of the macro backdrop, what we're both seeing now with this big bounce past the last time we actually got together and we were calling for this correction, and it has been extremely well timed. So how far can this bounce go? What happens after the bounce? Craig, give us our assessment of your economic read on CPI and beyond.
Yeah. So I was just looking, when we last spoke was Wednesday, the July 31st, which was the QRA Fed day, last day of the month. The VIX was 1636. The VIX closed today, or is right now, is about 1636. So it seems like nothing happened over the last 2 weeks, and here we are, just moving through summer very casually. Look, when we last spoke, we talked about how the Fed, was kind of setting up for a September rate cut, although it didn't want to pre-commit, and the market had already been pricing in, north of 3 cuts, and maybe even on its way to 4 cuts. This is before the payroll print, and so my view at the time was, the market's already pricing in a lot of easing. I'm not really sure, we're going to get that level of easing unless, the economy really starts to decelerate. And, what we saw from that payroll print on the 2nd, was a reasonably significant deceleration in labor growth momentum, which I think has scared a bunch of people. And I think even maybe stepping back, there's been some pushback against the, how slow is it? Some of it was weather, some of it was this hurricane, whatever. It doesn't really matter. At the time, on that Friday, there was then the view that, well, the Fed is clearly behind the behind the market, is clearly going to be late, is behind the curve. Add to that what was going on in Japan, which I'm sure we'll get to, which was this very significant yen rally on back of, the interest rate hike in Japan. And so the carry trade unwind kind of, accelerating. And, it seemed like, the wheels were falling off the bus very quickly right after we spoke. And, something that we were kind of looking for, but didn't exactly know when we were going to time it. And look, what we got over that kind of Thursday, Friday, Monday into Tuesday period, obviously was a significant correction, a vol explosion, a lot of fear, a lot of, quote unquote, smart Fed watchers calling for emergency rate cuts. And it was wild, 50 basis point cuts, emergency 75. It's amazing how quickly the narrative, tried to shift on back of a weaker than expected, although still positive payroll print, right? It was still job creation, wages were still firm. So, there's clearly a heightened angst about risk assets and kind of what happens if and when risk assets start to sell off. And so my view on that Monday, when we talked about in chat, was, look, they're going to come in on Monday, got to monetize, some of the puts, vol is exploding. Let's kind of trade this. This isn't the big one, but this is bad. And was really thinking we'd have that, kind of a gap lower, maybe a retest, and then a retest, and then go. And really what happened was we made a low in the middle of the night or in the middle of the morning. The VIX kind of exploded above 60, maybe. No one really caught it at that point in time. And for the last 9 days, it's just been vol selling every day. And it's almost gotten to the point where, like I said at the start, nothing happened. Right? S&P is basically back to where we were at the beginning of the month. The VIX is basically back to where we were at the beginning of the month. And this little episode, VAR shock, may or may not mean anything, from a short-term trading perspective. So, look, the question is, well, obviously, where do we go from here? And look, the CPI data and the inflation data this morning really, I don't think necessarily moves the needle anymore for the Fed. I mean, it's clear that inflation is coming down. Some might say, given the commodity price momentum and the goods price momentum and the deceleration in the economy, that goods inflation is going to come down a lot further, and we may be getting into some deflationary and disinflationary, bust type behavior, which we could talk about. But for the Fed, the key is labor. The key is the jobs market in order to get them to move at all and then move faster if needed. And so what we saw last Thursday on when the claims data came in a little bit better than expected, there was this relief that, well, we're not, decelerating into the abyss here. The Fed doesn't have to go 50 and it won't necessarily need to be an emergency cut. And, there was this relief and vol got sold. And we know what happens when vol gets sold, and markets can kind of levitate on that. It happens to be an expiry week also, which is clearly important, this week, in that there's, a ton of exposures that will come off the books Friday at the open and Friday at the close, which have been set, for months or reset. And, when we had this big move at the beginning of the month, now we traded into a fairly, sizable negative gamma position, which we've been in, but that works both ways. And so it's exacerbated move to the upside. Now we are basically close to the zero gamma line. So we've cleaned up a lot of the VAR shock. VAR shock. So now we're back to the economic reality. What is the economic reality? In my view, the economic reality is one of a slowing economy where the Fed is going to be slow to deliver accommodation. We have heightened political uncertainty. I mean, 3 weeks ago, Trump was going to win with a Republican sweep. Now Trump is losing in a majority of the polls and in swing states. And so the election dynamics have flipped, which, again, it's a little bit early to be betting on the election from a market's point of view. But from an economy point of view, it's going to be consumer outlays retrace, corporate outlays are going to retrench, hiring is going to slow, corporate CapEx is going to slow, because there's a huge difference in what happens if it's a Trump administration versus a Harris administration. There is a dichotomy of winners and losers that are very different. And so I think it just leads to more uncertainty, which is going to lead to further slowdown. The geopolitical risk is, still out there. I mean, who knows? We could wake up any day where something might happen. And so we are in the seasonally horrible period for risk, right? From the middle of August to the middle of October historically has been, I think, the worst time for markets. If you look on that, call it 8 to 9 week period, literally it's August expiry through October expiry. That is the crash window. It's been like that for a while. There's a lot of structural reasons behind that, around, the unpinning of vol, and this year with the election. And so it just seems like a pretty shitty time to be thinking about adding to risk. Now, the bond market is very much concerned about a slowdown, in my view. And we have seen a rally in fixed income, which has gone on and gone further than I would have thought, and seems to be running ahead of the fundamentals. But it is what it is, right? I mean, I wouldn't have thought that we'd have this level of strength in the bond market and still have this level of strength in stocks, with GDP running above 2%, right? I mean, there's a fear in the bond market, and it seems like it's more than just the U.S. economic slowdown. Maybe it's, partially because of dollar yen. Maybe it's some of the China slowdown stuff. I mean, China is terrible. Commodity prices in China are terrible. Money supply growth in China has not been reaccelerating. So, the UK has had its issues. Bond markets in the UK are ripping higher. Yields are plummeting. So there's a lot of angst and consternation in the bond market. And, it has, and bond volatility has stayed very elevated. It's something that I think I just tweeted about. There's been a divergence here where the MOVE index has moved back higher over the course of the last 3 weeks as yields have fallen. And so, I'm kind of pondering whether or not this is some sort of phase transition or a correlation breakdown that is worth noting, where it's bond volatility is rising as yields are falling, which suggests the bond market is growing increasingly concerned about an economic slowdown. Whereas before, we normally would see kind of a positive correlation, right? As volatility move higher, yields would move higher. Now it's the opposite direction. It's kind of worth noting. And so it seems like bonds are getting more concerned. Markets are getting more concerned about the slowdown. Equities are in their own land, and that's because of the vol selling. And every day, that flow is the biggest, most important flow in the market is the zero data expiry every single day, and they go home, basically flat every day. I'll just do it again tomorrow. And so I think now we've opened up a pretty wide divergence from where, with S&P at close to 5,500 and the MOVE index close to 120, it's a very big divergence here between bonds and stocks, and I feel like something has to give. But we're moving into, a little bit more of a dearth of data. There's not a lot of Fed speak, coming up until next Friday with Powell. We have retail sales tomorrow, but we don't really get a lot of data. So, if that means more vol, it's possible that may mean more vol selling, although we have come in quite a bit, and Friday's expiry, and that typically kind of reopens up that window of weakness again, for things to get reset for, second half of August. So I'm very concerned about the tape, but I'm also humble enough to realize that I wouldn't have expected VIX to fall like it has over the course of the last week and a half. The speed with which we've kind of taken out the equity vol is quite shocking. But cross asset is still to me seems very dicey with bonds, with commodities, with the dollar. So I don't think we're out of the woods by any stretch.
So it's interesting that VIX move on Monday pre-market. So between, let's say, roughly 1:30 and 3 a.m., lots of trades were busted and reversed, and VIX then was able to reverse lower. So it was also kind of a coordinated effort, in my opinion. And the fact that it hit that 65 area pre-market, it doesn't really, I know we count it, but I want to see it during regular trading hours. You know how I am just from the live trading room, right? When I see a gap and we trigger, after hours of pre-market, I expect that to hit again during regular trading hours. So I'm still, impressed as well. But this is the market we have. We had a reflexive bounce. So strong reflexivity after a massive pullback in NASDAQ of 16%, over 2 weeks. And SOX index was down even more. I don't even know, 25%. So and Nvidia was down 35%. So we had a reflexive bounce, but that bond convexity was really worth, it bears watching, because that reaction that it had to the interest rate move was definitely causing this equity sell-off with the yen carry trade. So in other words, yields crashed, yen spiked higher, and all of these things that we had talked about literally with clients since July 9th, and then again even publicly 2 weeks ago. And I had my top 10 list, the SOM rule, if it triggers, only needed 4.2%. It triggered 4.3%, as you mentioned, but there were green shoots in there. Some of the calculations were based on new entrants. So the point is, though, it's still a trigger for de-risking in a portfolio, right? It's still a recession risk pulled forward, and it's it's everywhere, right? The media, Claudia Sahm is interviewed nonstop, and but the point is, it's still a trigger, a knee-jerk reaction. VIX backwardation, which was something that I was looking for anyway, it was approaching negative, which is, below zero. And sure enough, it spiked, had a big standard deviation move, but it was a huge outlier anyway with this divergence that we already had with RSP to SPY, that chart that I keep showing that shows that extremely overstretched overvaluation of cap weighted SPY relative to equal weighted RSP or SPY. And it was just beyond an outlier that needed to revert. So it did and it still has room to go. So I absolutely don't think that that's done. But we had this nice kind of reflexive bounce in the meantime. We also had, as you mentioned, negative gamma. We've made it back up to neutral, but that's just repairing the VAR shock that you talked about. And that was a volatility explosion. It was cross asset from currency, right, to treasury volatility. So it was definitely a de-risking event that was not just triggered by the yen carry trade unwind, which I've written about a lot since November of last year. But it did help that we have the basis trade, which is that short treasury futures, long NASDAQ pair trade, which also is starting to unwind, which is not done in 1 week or 2 weeks. So the fact that we had, broken charts and then a reflexive bounce, it doesn't change the fact that we still have more yen carry trade unwind risk. We still have more basis trade unwind risk. We still have more RSP or to SPY or concentration risk unwind. There's Volmageddon didn't, trigger to reprice the market to stay broken. It didn't break VIX either. It literally closed shop. So options weren't even pricing correctly Monday morning. That's one way to keep people from selling. Anyway, the CTAs you have also brought up in the past is a level of kind of trend following, long or short. They were slated to sell. Right now it looks like they've done a good amount of selling. They could actually come in and support the market a little bit. Stock buybacks, it's something we also track for institutional, level excitement, or I should say not headwind or tailwind. That's going to come back into play. So there are definitely reasons why we can get all that put monetization in options and then some structural buys. But to take us up to all-time highs and above, like the Yardeni 6,000 price target, I'm going more suspect, because that pullback that we had and that we timed really, really well from July 9th, literally, was very damaging to charts. It was very damaging to the psyche. And earnings have to blow it away, and they're not, right? They're disappointing. So earnings are not creating this expectation that they had priced in. And we definitely have Fed rate cuts on the table to cut or not to cut. I personally think they're going to cut, and I think it's going to be aggressive, just because I think the damage is kind of underneath the surface and they don't want it to come and percolate, too loudly up on top. But what's your feel for the kind of this debate now that because GDP is in that 2 to 3% level and inflation in the 2 to 3% level, the Fed doesn't have a mandate to cut and employment isn't that bad yet? So what do you think the chances are, and where do you think we go from here?
Yeah, look, I mean, I think there's this, this belief in the markets that the Fed moves rapidly. And it's not the case. They move slowly. They only move rapidly in times of great, disturbance in the force, let's say. So right now, you basically have a market that's looking at these 2025 rates at about 3.1%. The dot for right now, which is the June dot, which we can see for the Fed for 2025 end, is at 4.1%. So the market's already 100 basis points ahead of the Fed for cutting for 2025. Only one of the 19 members has a dot that low. 18 of the members have dots that are 3.6 or above. So basically, the most of the Fed is very, very far away from the market at this point. So we're just not going to get a quick move in the dots. Even if you go back to March, there was only like 2 members who had a dot for 2025 that was as low as where the market is now. So you're just not going to get a very big move in the Fed's cutting expectations when you come out in September for next year. Now, yes, are they going to cut 25 basis points in September? Yes, but the market's looking for 4 cuts before the end of the year. How are we going to get that? Are we going to get 25, 25, 50? Why? Why does the market believe that the Fed is going to deliver even? There's not one member that believes in 4 cuts right now, as of June. So you're talking about moving the entirety of the Fed to 4 cuts when not one person 2 months ago thought we were going to have 4 cuts. I mean, so again,
I love this argument, by the way.
the
It's
market
a
is
really good one. But
the market is
entirety
very
of the yield curve
yeah.
collapsed. I mean, everything crashed.
The market's very far ahead of the Fed, and in order for the market to be delivered that level of rate cuts, we need to see that deterioration in the data. And look, I mean, maybe we'll get it tomorrow with retail sales. Maybe they'll come in terribly, even though we're expecting a sequential acceleration after a weak June. But it's not clear to me that the economy is slowing as rapidly yet to justify the market's pricing. Now, you may say, well, Craig, the market always looks ahead. And, the market's, it just anticipates. And so the Fed will get there eventually. It's possible. The market also thought we were going to have 6 cuts, when we came into the year, right? And we went down to 1. So the market's not always right in their expectation about what the Fed is going to do. But the calls for an emergency meeting rate cut, 2 days after the Fed just, did it. I mean, it's literally ridiculous, but it shows you, kind of how the machine works and how Wall Street kind of needs number go up, right? They need stocks up, they need, risk on, and they want that Fed liquidity, which I have referred to as POM, right? The perpetually accelerating liquidity machine. They want it all the time. They want more money from the Fed, cuts, easing, always. And so, look, I think that it's going to be, if the S&P is 5,500, the Fed's not delivering 4 cuts. If the S&P goes down, is down back to 5,000, where we were a whisker away from that, maybe,
Yes,
on Monday morning.
Mhm.
Then all of a sudden the Fed may be delivering those 4 cuts. So we're in that balancing zone right now where I think, the market's going to start to be disappointed if it's not assured to get the level of easing that has already been priced in. Now, look, it may get this level of easing. The economy may be rolling over rapidly, but if that's the case, I don't think equities are going to be 5,500. They're going to be a lot lower.
Yes, correct. And we've talked about that. 4,800, maybe, in time, I believe, if we get triggered, which is that 3.8% 10-year yield. And by the way, that has dropped 100 basis points in 2 months. So one of the reasons why I am, very, very focused on more aggressive Fed rate cuts. So behind the curve, even if the economic data right now isn't pointing to it, I still see this dramatic drop from the 2-year 5.8 to 3.8, and the 10-year from 4.8 to 3.8. I'm rounding, but you get the point. It's well below the Fed funds rate. So that's why I'm still expecting.
Yeah, look, I mean, it's interesting. It's interesting. I tweeted this a couple of times today. I read this Husband piece from July, and look, he's a doomer, but he puts out good research and he writes interesting things.
Yes, he does.
And one of the things that he mentioned just about investor psyche and about the falling yields is, at the worst markets are when the Fed is easing, but investors view easing in a more of a nefarious way as opposed to in an accommodating way. And so he refers to, the shift in low interest rates from being an inferior asset to being a desirable asset. So at some point in the cycle, as rates are falling, people say, well, I don't want an asset that has a low yield. This is like the QE era, right? When yields are low and the Fed is buying bonds, I don't want a 0%. I want to go move out the risk curve. But then there are times in risk off when low yielding assets are desirable. You want them because you're concerned about the future. And so, what I think we've had so far is this drop in yields, let's say in the 10-year from 4.8 to 3.8, has led to multiple expansion, right? People have kind of flocked into equities. Tech is still very elevated and stocks have been very elevated despite this rally in bonds, because people are saying, I don't want the low yields. I want to move my money out of low yields into higher risky things. But in my view, and under the surface, it seems like the transition is underway where there's an increasing amount of people who are looking for safety in yields. They are growing more concerned about the state of the environment or the state of the economy and the markets. And so at some point, low yield actually becomes desirable. You want to put your money into bonds. You want to take it out of stocks. And so that is the worst environment for equities, is when the Fed is cutting, but that the cutting doesn't do anything. I'm not saying we're there yet, but I think that we are on the path to that environment.
So
if bonds keep rallying here, I think we're going to get there even quicker.
Okay, so on May 7th, I actually just posted that this morning and went over it with clients. I had a client post that was basically, what if yields crash down, not up? It was the opposite of the higher for longer camp, right? So that proved prescient, but that's not the point I'm getting at. I actually pitched, speaking of, safety plays, that XLU, XLP, XLV as a way where it's just not going down as much. It's not as risky. And it has done extremely well, in some cases flat, or higher.
I mean, some of those utilities are at the highs, right?
Yes, but I mean, the healthcare in particular. So there is still money rotating into these kind of safety plays. And I still believe tech. I still think this is just a reflexive bounce, and we're going to be in short the rip mode instead of buy the dip. And that's a big change, right? I mean, This was literally a change since we talked for Edge clients on July 9th. I mean, call it lucky or good, but we were like, we see the market rolling over next, and here are the reasons. And all of the things that we've just talked about, many of them have triggered. So, and this reflexive bounce is one thing, but the bond convexity, which I've talked about and written about, is just not done. And the leverage unwind. So I go through it and I see the points of that you're making, really solid ones of, okay, why the Fed wouldn't move quickly and why they wouldn't hike aggressively. But I still see recession risk getting pulled forward. Okay, number one, slowdown in growth, unemployment. All we need in jobless claims is 267,000. And I'm very, very bearish after that, the VIX spike immediately. And not to mention this growth scare that we just had with tech dropping precipitously very quickly on a yield crush.
Yeah.
Okay, so we have leverage unwind, plus we have a growth scare, plus we have recession risk. Seriously, besides a reflexive bounce, which you trade, why load long into NASDAQ or SPY right now that has such cap weighted heaviness that is, I still believe strongly, overvalued versus the safety plays? That's all.
Oh, look, look,
a baseline bet.
I looked like an idiot about a month ago as IWMs were ripping on the unwind and making a high, but I kept saying to people, you don't want to buy small caps on a rotation because of lower yields into a slowing economy. And I said if there was a rotation out of tech that I could buy, it would be into defensives. I said that makes more sense to me. It was rotation from tech to defensives, not a rotation from tech to small cap. Now, what happened was the first stage was a rotation from out of tech into everything. So the small caps, ripped. But subsequent to that, what we've seen is what I would have expected, which is small caps have come in, have been underperforming. Defensives have basically went to the highs. And at first, NASDAQ fell. Now it's kind of rallying back. It's out. Now NASDAQ is outperforming IWM. This all kind of makes sense, and I think is indicative of this, again, slowing economy, slowing earnings momentum, a Fed that is late. And so the question then becomes, well, when are they going to sell tech, and when are they just going to sell equities? And because they were doing it last week or 2 weeks ago into the end. Now, I think they're going to start again. And maybe it's maybe we just need to see Nvidia's numbers. Maybe we just need, which is next Friday, which is in 2 weeks from today. Maybe we just see Walmart tomorrow. I don't know, right? We need to see. Maybe we just need to see earnings.
To see the 10-year break below 3.8%. I have been on this for many, many months. I started on this going, okay, What if yields crash lower, not higher? So an overshoot, that's where we are right now. So falling into 4.2 breaking, falling into from 4.2 to 4%, little bounce, but that was like took a nanosecond of a bounce, and then it crashed not to 3.8%, which is major support, but it went through it. So in my technical analysis world, it's going to revisit that, right? This is going to revisit that. And so I don't see Walmart or Nvidia. Nvidia, of course, is a sentiment play for sure. And it would be dramatic if they miss. And it would also be very bullish if they don't. But the point is, I still see the oil weakness, yield weakness, unemployment claims strength, or these are bigger triggers for a call to have more de-risking intact and a yen continuation. And I got to tell you, yen, when it started out and we started talking about it literally in the middle of July, I'm like, okay, maybe it'll make it to the 50-week, but no, it's now spiked above and come back and basing above the 50-week. That's a trend reversal pattern. So I'm even more bearish longer term, not this month per se, but I'm talking about I've turned bear into the end of the year. And for 2025, if this continues to have a global unwind.
I think that, look, I mean, I think that's very much where we're headed. And it's just a question of the speed and the timing of which, right? I think.
Or the reason, like he's asking or she's asking, what are your fundamental reasons for the 10-year breaking below 3.8%?
It's macro. It's growth deterioration, right? It's U.S. growth deterioration. It's China growth deterioration. It's Europe. It's everywhere. And I think what you're seeing is look at iron ore and rebar in China they're at the lows. They're getting pummeled, right? I mean, copper's been poor, oil's been poor, bonds are, copper to gold ratio is making new lows, right? Bond market is ripping. So these are all signs
not doing well.
These are not credit has come off. The credit spreads have widened a little bit, not enough. I mean, we like to see a little bit more credit widening to kind of, really push on the negative equity bet, but I think we're going there. I think that's how you get it. And look, I think that I've been trying to think about this a little bit more, but we've had now, call it 2 years or so of this dynamic of high rates in the US with a big deficit in the US leading to flows of assets into US assets, right? US equities, U.S. treasuries on carry trades, right? Not just borrowing in yen to buy treasuries or whatever, or tech, which is I think that's a dynamic, but it's just a structural thing. If you're an overseas investor and you're looking and you're like, Japanese households are doing it, European households are doing it. People everywhere have been buying into this U.S. outperformance story, which has been aided by high interest rates in the US and corporate profits that haven't been hit. To the extent that the Fed starts to remove that incentive to invest in the US because rates are coming down, that you start to lose the bid of foreign investors investing in the US. And so I think that is the dynamic that is
more
in
than
play.
Losing it. They sell their equities and they go home.
And I think we saw the first wave of that over the last 2 weeks. And because when there was a call for the emergency cuts and when interest rates really got hit, US equity market sold off aggressively, right? You saw that unwind happen. And that was, I think, just the first tremor. I know JP Morgan said, we've cleaned up 75% of the carry trade. Yeah, maybe the most levered part of it, but we've had structural flows into the U.S. for years, and that's just 2 years. Just 2 years in the hiking cycle, let alone the last 15, let alone the last 15 years. Right there's a lot of flow of international owning of U.S. Equities, and so as the Fed cuts rates and the dollar falls, and we lose that advantage of investing in the U.S., this whole thing could start to unravel in a very sizable way. I think that the Fed and Treasury and the deep state, whatever, the powers that be probably wanted to have this happen next year or certainly after the election. maybe from a conspiratorial point of view. And so the Fed didn't want to start cutting before the election because it wanted to keep things, if you really want to, go crazy and believe all the conspiracies, which I like to do. But, there's definitely a view that folks in DC do not want Trump to be the next president of this country. And so keeping the markets afloat until the election likely benefits Harris, or likely benefits Biden, and then now Harris. And so there certainly was a view to kind of keep things together until November. Don't let the markets fall. Don't engage in a rate cutting cycle, because this dynamic of carry trade unwind would be in play if the Fed were to cut. And so deal with this later, and 2025 would be horrible, but then, we have 4 years to build it back. I think that was probably, Powell and Yellen have breakfast every week. So I imagine this has been.
But how long?
Powell admitted that. I was shocked when he admitted that a couple of weeks ago. He told David Rubenstein he meets with Yellen every week. I was shocked to hear that. I think many people were shocked to hear that. But anyway,
no, I'm not surprised.
But I'm shocked to hear that he admitted it.
Oh, okay. So how long can they keep this going though?
I think that's the problem. The market is sussing this out too quickly, right? It's kind of it sees blood in the water, and it's not going to allow the Fed to just kind of gracefully kick the can to November and December. It's saying, you know what, it's go time now. You better cut, and you better cut aggressively. Otherwise, the economy is going to roll over. Yeah, and we're going to have a real problem. And then I think this is we could be in the period here between now and the election where the markets fall, 20%, because we get these carry trade unwinds, bond rally, yen rally again, right? And you get the foreign selling of US dollar assets. It could get nasty real quick.
So I posted this for clients. I had a line up on top. It was like 5.8. Sorry, no, doesn't matter. It has come down in a head and shoulders. It's broken the 4.2. That's one of the reasons. And I don't know who was talking about aggressive rate cuts. I mean, okay, there's Jeremy Siegel, but I am on the aggressive rate cut rant now, because I see everything across the curve, right? From my 13-week, 2-year, 5-year, 7-year, 10-year, 30, everything to me is lined up for a continuation breakdown. And that just means to me, credit spreads had a little, quick spike higher. Let's see, I posted this for clients. Let me just grab that. Where the heck is it? And they came right back down. I know I'm making you crazy. We just need to, and you can't see it, but this is 4.05. This is the high yield. That's not so hard to imagine. We're gonna poke above that and have more tech selling. It just is a question of the trigger and the timing. But for right now, I do think that forced selling, like we just had in the NASDAQ, okay, 15% drawdown, and then a reflexive bounce. Everyone's now talking back the rate cuts. We just need another one.
This is what happens when the Fed decides to, put out every little fire before they really happen. And so you kind of have a situation where the Fed has really forced itself into this incremental approach, right? It only does big moves in crisis because it wants to always tell people it's all of its credibility is based on this idea that it spoon feeds the market exactly understands it. So the idea of an emergency rate cut, it's ridiculous in an environment where the S&P is 5,500 and employment is as strong. Emergency rate cuts happen during COVID. They happen during the great financial rights, because the Fed has not allowed itself to operate in such a way where it could be that nimble, where it could say, yeah, you know what, we made a mistake. We should have cut in July. We made a mistake. We're gonna just rectify that really quick. They don't give themselves the ability to do that. So the market then can only get kind of super normal or abnormal cutting when it revolts violently, right? And so even now we're you could argue we need 50. I think Gunlock has even said Fed should go 150 this year, but the Fed's not going to do that with the market here, right? So unfortunately, we're in that weird place where the only way to get an aggressive Fed reaction, and which would really help the economy, is for the market to sell off. And so every time the market front runs the front run, we just don't don't get it, which is why the economy is going to slow more than people realize, because it's already been, it'll be 15 months between when at these rates, right? The Fed did its last hike in July, and it's going to do its first cut in September of the following year. The economy can't handle this level of interest rates for this much longer, for sure not.
So I'm not gonna say history rhymes, repeats, and all that stuff, but I saw a thread that you were in, I think it was yesterday, and basically the Fed cut in January of 2021, but the market, NASDAQ, didn't peak until March of 2001. Sorry, repeat that. Let's go to the big bubble that we had in NASDAQ, 1999 to 2000. It was a 100%. Trough to peak. March of 2001, we actually rolled over, and the Fed had started to cut in January. We literally just now ran from the January 2023 low into the July 2024 high, 92% in NASDAQ. We are expecting a September cut. We had also in the great financial crisis, they cut in September of 2008, and the market started rolling over in October of 2008. So there is a reason for us to kind of look at this, and the Fed to say, we really don't want to cut yet because we know what's happened in the past. So traditionally, stocks haven't done well once the rate cutting cycle starts. So it rarely is a soft landing achieved. And this is one of the comments being put out by Marty. So could this time be different? Sure, I don't know, but
I think there's like
I'm very bearish nonetheless.
Yeah, me too. But there's normalization cuts, and then there's accommodation. So a normalization cut is, okay, we've been tight for a pretty long time. Real interest rates are pretty elevated. Inflation's kind of coming down. Let's tinker, right? Let's start taking the rates down. This was like the mid-90s idea, where the Fed cut in 95, I think, 94, 95, and the economy just kind of kept going, right? And that was, we just want to take a little bit of the restrictive policy out, so we're going to normalize policy. If the Fed is normalizing policy, then the rate cuts don't have to be negative, right? It's not a reflection of an economy that needs accommodation necessarily. It's a reflection of an economy that no longer needs this level of restrictiveness because inflation is not a problem. When that transitions to accommodation cuts, the Fed needs to cut in order to prevent growth from decelerating more aggressively. Those cuts are typically sell the news type cuts. Those are equity negative type cuts. And you don't buy the first cut, you buy the last cut. You buy when the Fed has eased enough to actually make a difference, and you're actually seeing it, in the real economy. And we're just so far from the last cut at this point.
You nailed it by saying it, normalizing cuts versus accommodating, right? So they're going to sell this lipstick on a pig as normalizing cuts. We know this. They've already queued it up. They've teed it up. There's no question about it. They are pushing this as normalizing only, not accommodating.
Yep.
But it is policy interference nonetheless, just like it was, when they did the Fed pause, right, on November 1st, and markets took off like hot fire flames, aided by QRA Yellen, who issued more bills than notes and bonds. So this is still policy interference. So when do they stop accommodating? Like, when do you see them as well, obviously, if their jobs are removed, that's one thing, but we got 91 days until the election for that. And Powell still has his power until May or whatever of, what is it, 2025? Yeah.
2026.
Oh, we got tons of time. So they can still come in and interfere for sure. So when do you think they kind of stop accommodating this this market charade, for lack of a better word? And
look, I think we've passed. I think that there are definitely some folks out there who believe that that policy rate, that 10-year yields have come down, mortgage rates have come down, and the financial conditions are loosening again, that the economy will kind of find a find its own floor here and we'll just rebound into 2025 on back of these lower yields. And look, and then if you believe that, Trump comes in with with a tax cutting, plan or whatever, or pro-business plan, that could get people excited about, next year. Again, it's too early for me to tell, but but I disagree with that view. I don't think the economy is going to, I think we had this financial conditions loop that we've traded over the course of the last couple of years, where every time, the Fed got a little dovish, financial conditions would loosen, animal spirits would come back, inflation expectations would move higher, and the economy would reaccelerate again. The economy benefited from high savings rate and from hiring momentum and strong wages. Those things are gone. The savings rate, excess savings is gone. Wage momentum is gone. And
We
so
just need a refi wave.
so I think the refi wave, if it were to come, it's people who are refining to pay credit card debts, right? They're not going back to it's a different type of cycle. And still, most people still have mortgages that are 2021 or earlier vintage at much lower rates.
Correct.
So you're not really going to get a boom from that. So I think the economy is going to really slow. And I think the Fed's going to have to give a much larger degree of accommodation between now and next year in order to prevent a much bigger slowdown. And so I don't know when the cutting is going to stop. But what I think is going to wind up happening is we're not going to have a cut 25 a meeting type environment. My view is we're going to have an accelerating type cutting environment as the economy rolls over. And so maybe we go 25, 50, 50, 75, 75, right? And so that would be, 275 basis points of cuts in the next 6 meetings. I think that's more likely than 25, 25, 25. So I think if there's value to be had in SOFR, short-term interest rates, it's for a much more aggressive cutting cycle sooner. And because I just think that, imagine if Trump's in there and the economy is rolling over, he's gonna be begging for 50s and 75s this, come January and March, right? Let's get it over with. As opposed to like, let's go 25 a meeting for the next 8 meetings.
But we need more forced selling or more de-risking, right? This leverage, global leverage unwind. Lonnie mentions that she knows a lot of business owners that are hurting right now, and it just prompted me remembering this data of Chapter 11 filings, right? So they've reached the highest level in more than a decade. Small, medium enterprise bankruptcies have more than doubled in the past 2 years. At the same time, Nvidia, Microsoft, Apple market cap equals 33% of GDP. Just last month, before the little minor, blip here. This is the market we're in, right? So we still see the warning signs, but we don't have Fed cutting aggressively or talking about it aggressively, or even positioning in the dot plot aggressively. So something really needs to trigger in order for that to happen. And my opinion is still 10-year yield drops that 3.8% and stays below it. We're going to have more tech unwind, and all of my intermarket analysis that I've been doing for clients for the past few weeks that show this unwind is not done will, I think, create the forced selling equals forced cutting. So I'm still in that camp.
Yeah.
And we're going to have more, but
me too. I mean, I think we're going to have it between now and the election. I think we're going to have a very dicey next 10 weeks or so of data that gets worse, a Fed that's got its head in the sand, and an election that becomes even more contentious between now and then, and certainty continues to rise. I don't really know about the Middle East situation. I don't think it's going to end tonight or tomorrow, and that at the ceasefire deadline. I mean, maybe it will, but I think it's more likely to see an escalation than not. So you're really just putting up a tremendous amount of headwinds for risk taking.
There is one benefit, though. If there are negotiations that result in peace, the dollar will rally. That's a headwind, obviously, for equities, especially if yields drop. But it is bullish, the dollar. So
I don't know. I don't know if it will be.
Oh, really?
I don't know. I don't think there's much. I don't think there's much currency. I don't think there's a big currency view on geopolitical with Middle East type stuff. I think if you believe the Middle East stuff went away, you'd see oil fall.
The oil
But
falling.
but
I'm
but I don't
very
know about the dollar. But look, I'm not necessarily bullish the dollar, but I'm just I don't know if that's a reason to be
I
bullish the
definitely see
dollar.
I see oil falling, and this is a big macro thesis. It hasn't triggered yet. Marty asks, or I should say, comments on reverse repo. Can you talk to that? They also access the reverse repo rate market to save the markets around August 5th during the yen carry trade short volatility unwind. They are still dropping the reverse repo market to prop the market now at 328 billion. Any thoughts on that?
Look,
No, Marty, I'm not talking about the dollar rallying. I'm talking about
No,
reverse.
I know.
Okay.
I think there's look, the reverse repo facility is a facility that investors use to park cash at. And so if they're removing cash that's yielding 5.3% overnight at the reverse repo and putting it somewhere else, arguably into T-bills at lower rates, that's because they're trying to lock in T-bill yields for a period of time, because either they're concerned about the Fed, having to cut, in which case they have reinvestment risk, or they need that T-bill collateral for some reason. So I don't. The reverse repo facility is not used as some sort of facility that's helping that's like being used by the Fed or being used by Treasury. That the facility is being used by investors. Now it's the question is whether or not like the exchange stabilization fund or some other fund or some other vehicle was used to help with dollar yen trades, or again, these are conspiratorial type things that are impossible to know. The markets act as though the heavy hand is in there, and that there's somebody who doesn't allow the market to fall, and they have facilities that they could do without giving any disclosure. But I don't know. I mean, we didn't see the swap lines used when the Fed gave its update last week about the balance sheet. We'll see tomorrow after the close whether or not swap line was used. I don't suspect it was. So I don't think that we know that there's an active heavy hand in there that's trying to save the market. But I do think we're in a situation where if the dollar weakens too much, we risk unwinding further some of these carry trades. And if the dollar strengthens too much, that puts a headwind on maybe emerging market growth and emerging market government ability to pay down debt. It's like we're narrowing the band of acceptable dollar price. It's like if it go too weak, it's bad. If it go too strong, it's bad. Like we need this Goldilocks FX environment in the seasonally bizarre period ahead of an election where every country is kind of incentivized to likely weaken their currency ahead of potentially Trump coming in and tariff regime. So I don't know. It just seems like a lot of unknown things and a lot of reason to be uncertain. A lot of reasons for volatility to remain bid. I know Treasury is meeting in China this week, not Yellen, but there's other Treasury officials who went to China this week to talk about financial stability. And I mean, it's Blinken's supposed to go to the Middle East, right? There's a lot of important people flying around the world because I think that risks are high ahead of the election. And so but for us, I just think, again, the time of the year is horrible. The seasonals are poor. Vol is now, extremely low again. And I just don't think we're out of the woods by any stretch of the imagination. Look, the zero data expiry vol selling machine is powerful, but this to me seems like a very horrible setup for risk between now and, let's say, October expiry. And I don't want to have anything to do with it on the long side.
Okay. And I have a chart I want to show you before we close. It's an important one that I've kind of posted before. And I have lots, of course, that I post for clients. And we do this. Do I have this showing in the right place? Yes. This is just in reference what I was talking about, this kind of concentration risk up here in cap weighted SPY versus RSP, which is equal weighted. And I had warned, right, strongly that this was an outlier looking to reverse. And then we had the hedge fund factor rotation short covering rally, which actually triggered it to start back in June. And then we were talking about this and you're like, but I still don't trust the Russell, and for really good reason. So Russell has obviously crashed and careened right back down. But the long story short is this has an enormous amount of divergence and closure. So I don't think this is just one and done, but we have definitely rolled over in concentration risk, and we have definitely, rebounded in this equal weight. Again, a lot of the safety plays that we've already talked about, and I just don't think this is done. Also,
just to add on that, I think that's going to play out over a multi-year period,
months,
right? I mean,
months,
multi-month period, multi-month, maybe
Correct.
multi-year period, as tech kind of deflates.
Correct.
The expectations are too high. One earnings miss by any one of these companies is going to be a real problem. And yes,
well, one company in particular.
One that reports in 2 weeks, probably.
Yes, and by the way, this is NASDAQ on a monthly relative to SPY, and I've been, reviewing this in the macro to micro. Clients have it every week, but the point is we have already, gotten rejected here at the beginning of the month and come down firmly. This is buy tech in the channel, short tech at the channel breakdown, big picture. So yes, we can have a little reflexive bounce, and believe it or not, that's in play. But semis relative to SPY have definitely started to roll over, and I'm expecting a retrace down to that 2000 high, and then we break that, all bets are off. We definitely have a bearish market backdrop. But this is part of what we do, by the way, for clients. And we had this kind of macro to micro power hour. It's 5 o'clock, and I wanted to just end with James has kind of present this going, hey, you guys do such a bang up job publicly for clients. This is for free every once in a while, right? When we have a kind of market moving event from a macro standpoint. Today it was CPI. We've got Jackson Hole next week, FOMC soon after. And there's a lot riding on equity and bond volatility. And we're on it every single day in every single way, cross asset, all time frames, working very actively for clients. Live on the phone, Zoom. So just in the spirit of that, we have a 20% off. This is fabulous Macro Edge 20 coupon. If you want to elevate that level of kind of trading, which is customized pro to pro engagement with Craig, myself, Jeffrey. This is very much everything we offer. Plus we have a bench literally of 10 contributors from macro to micro. So I want to, given the kind of complexity of the market right now and interpreting what's going to happen next and how to trade it across all assets and multiple time frames, I wanted to throw this up as our ending screen. And then basically just thank you very much for joining us today and your questions and comments, and Craig for being back in the hot seat. Literally safe travels with your daughter tomorrow. Any final thoughts you want to put out there, given we won't do this again probably until FOMC publicly, and we do have Jackson Hole. Any other final thoughts?
Yeah, look, I mean, I think people have traded this market, a lot of new people in this market that have done well, trading momentum names for all year or for years. And we have, our client base has grown with a lot of new faces and a lot of new people who have really, my understanding is I've only really seen kind of a one-way, move up in markets and in the tape, and where the Fed's providing liquidity and kind of make it easy. But there are times when macro really takes over, and there are certain times of year, there are certain times of month where it really matters more than kind of individual single stock stories. And so just, I think people need to be mindful that we're in that kind of setup right now. And that even though you may have a great idiosyncratic long idea of a company that's has pricing power, gain market share, whatever, the beta to the market and the beta to the industry and to the factors that surround the particular stock can really trump any of the idiosyncratic stuff that's going on. And so you need to be hedged. You need to be mindful of that, because just like a rising tide can lift all boats, a tide that's going out can really dunk, any and all boats here. And this really feels like a precarious time. I mean, I think if you were to ask anybody, when's the most nerve-wracking time, of the year to be thinking about investing, it's now. It's the middle of August to the middle of October. It doesn't happen every year. But if you go back through history, this is a time where we've seen large corrections, a lot of volatility, a lot of back and forth trading, liquidity coming out, and you have Jackson Hole next week, which is not going to be necessarily something that I think is going to be something that people feel excited about. It's not like Powell is going to deliver some sort of exciting message about what the central bank could do just to help this economy. He's just not going to do that. And so after that, you have payrolls the following week, which are going to be, very much analyzed. And if we have another soft payroll print, sure, we're going to bring in 25, maybe even 50 for the first cut. But I think the first cut is a sell the news event. The Fed cuts rates in September, and then you can really start to sell. And I think that's the setup that we have really between now and the election. And look, I mean, if the election goes in the way of Trump Republican sweep with the market at the lows and volatility at the highs, we will buy that market with two hands on November 5th or whatever day that is. But we got to get there.
Yes, we definitely need to get there first. So in the meantime, in the in-between time, welcome back. Thank you everyone for your questions, feedback, comment. And we'll see what there is for Jackson Hole and Nvidia coming up. Woo! All right. Cheers, everyone. Have a good night. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.